Okay, let's talk about the investing methodology. Right. What happened to the SaaS? Why are they dropping down suddenly so much in the price? Okay. Now, this is the free cash flow of a company. So earlier video, we talked about the company that when you invest in a company, you look at the free cash flow going forward, right? And since the advent of AI, the year is probably around 2023. A lot of the mega sevens and the SaaS started to have to put money into CAPEX. And what CAPEX does, so if this is free cash flow, okay, it should be quite similar to net income, right? However, a lot of the SaaS, a lot of the tech companies realize that, hey, if I don't invest in CAPEX to boost my AI, I could give up, I could lose out, and that's the end of my business. So a lot of money is to put into CAPEX, and it worries the market. And imagine, right, you are growing at 15-20% a year happily, and now you have a huge CAPEX growing, so your free cash flow is going to come tumbling down. And there is no guarantee that 2-3 years later it's going to work out, there's no guarantee of it. Because to be honest, you could be investing a lot of money just to keep your customer. If you don't do it, you're out, right? I gave an example of Tax SA, right? And so those companies that pay out a lot of dividends, payout ratio of 60%, they have to suddenly cut their dividend, show a signal that I can't sustain this dividend anymore. And what happens? All the pension funds, insurance companies that buy them for the dividend will leave and the stock price will tumble. So they don't have enough money for stock buyback as well. So when does this ROI pay off? So take, for example, Salesforce SaaS, CRM. And they used to grow at a very high rate of 15.22% per year. I think that's about right. You look at the free cash flow, they will at 29%. It's never going to happen again, right? Free cash flow. So this is a rule of thumb, DCF method. Free cash flow, 29% growth. Let's have it 15% growth. The growth rate at a price to free cash flow, let's say the faster you grow, the higher the P they're going to prescribe. It ranges, the P to growth ratio ranges from 1 to 3 times. I would say 1.5 is fair. So at 15%, we do 23 times P. It's never going to hit the average of 31 times. Let's be conservative. Okay. And then you're not too sure if the growth will continue to decay. So a fair bit of disruption, 20%. It's up to you. You can put it 0. It wouldn't move much. And then doesn't pay dividend. Okay. Now, I would, at this rate of free cash flow growth, is 69% undervalued. The stock price is 312. Buying today at 22.17% from today's share price. However, you know that SaaS, there's going to be a lot of investment into CAPEX. So this free cash flow may not even be sustainable. Okay, so to smooth out the earnings, let's use net income. Net income grow at 15%, about right. P ratio will, Fed hope is going to be 170 times. Let's put 23. And then let's give them a fair bit of annual, even if I put growth decay, I put 0. And 5-year holding period, how would the annual share price, let's say they're going to do share buybacks, 3%, minus 3, minus 2.5. Although historically, it's always been dilutive. The share fair value is 254.86 with 254.86. Okay, is undervalued with, if you buy now, there's a 17.3% CAGR return, 37.6% undervalued. Okay, so you realize that, yeah, maybe the shares are cheap, provided that the growth rate will be 15. Now, if you stress test it and say that, okay, I think they will be disrupted, let's put a 10% decay. You're still, it doesn't move the needle very much, right? 22% undervalued. Fair value now drops to 226.25. Okay, let's do a reverse DCF. What is the growth that will lead to the company's fair value equals to the share price? Okay, so you do the annual change, delete it. Okay, just don't assume anything. No decay. And put 10% growth and maybe put 15 times PE. Well, that's, it becomes 36%, 37% undervalued. If you put about 18 times PE at 12% growth, still undervalued, yeah? So just imagine if the company grows less than 12% and the PE ratio comes down to below 18, you're never going to meet this requirement. It's very easy to undershoot and to disappoint everybody. So I put 13% and 20 times PE, yeah? For it's about right. So in order for the, what does it tell you, in order for the share price to meet the requirement, okay, at this current price is factoring in 13% growth at 20 times PE. Is it likely to happen? Is it likely to outperform or underperform? I will say that it is likely to outperform slightly. It will not crash and burn. 15 and 23 maybe, but look, is it within our expectation that it will never drop below 13%? We don't know how bad the disruption, AGI, okay, artificial general intelligence comes in, then it could change everything. And they need more and more and more CAPEX. It's like a nuclear arms race. So at 15% growth and 23 times net income, don't forget this depreciation of the CAPEX spending can spread over 3 to 5 years. It will suppress the net income. It may not even grow at 15. So at this level, I'm getting 19% undervalued and 14% CAGR growth. Do you accept that? So have a think about this. There lies a problem here. So Adobe, software company, another SaaS company. Okay, how at this rate we are predicting, my God, let's not even talk about 40 times PE. Let's talk about 20 times. Let's talk about 10% growth of Adobe. Everything else, they are buying back a lot of shares. So you leave everything aside, no growth, decay, nothing. It is at 10% earnings growth, 20 times PE, is 53% undervalued and 20% per year. Very easy, right? To just now you saw CRM, Salesforce is 12%, is 10. So I could put a very nice 15 times, which it's never been, I think this historical earnings, so it's never happened. Forward is about 12, 13 times. So this 14, 13% growth. So Adobe is a lot more manageable at this stage. Would they be a huge rebound, huge undervaluation, and will it make a V-shaped recovery? Hard to say, right? So there are, the next couple of years, the revenue is likely to come down. And that's why I'm trying to say that it is, these are challenging times. Not all SaaS will flounder that way. So we group them into the top 10 holdings in my fund is roughly going to change, but I just share with you some of the things that, okay, that, these are the group of companies that I hold as a heavyweight. First of all, the first group, AI infrastructure and hyperscalers. Okay, the companies are building and monetizing the AI boom, chips. Okay, step one to analyze the company, understand what is the revenue driver, what is the biggest portion of their business, and what growth rates are they going. So Nvidia, they are the bullet makers, they are the picks and shovels. Okay, you probably need them. There are a lot of competitors, they are making their own chips, but they are here. Okay, for the next 3-5 years, hard to take away their moat. Data centers, AI GPUs, networking, Grace CPUs, it makes up 85% of their business. A lot of it is supply data centers, right? Gaming and auto make up the rest. Historical growth rates were 100 to 200% year on year. During the AI build up, in future, it probably normalize to 20 to 30%. So at 20 to 30% growth for the next 5 years, CAPEX will stabilize, likely to trade at, even at 25% growth is 38 times PE. Okay, it is still undervalued. Let's look at the AI disruption, zero beneficiary, zero. They are net beneficiary, they are picks and shovels of the AI gold rush. The only risk is cyclicality. So if SaaS companies stop buying AI compute, then the data center revenue will contract sharply. Next, ASML, they are monopoly. Revenue drivers, extreme ultraviolet and DUV lithography systems sold to TSMC, Samsung, Intel, plus high margin installed base management, servicing the machines. So a large part of the revenue comes from that, from the EU lithography. I think the recurring revenue is about 20 to 30% of it. So historical 15 to 20% high cyclical base fab build-outs, future 10 to 15% by the transition to sub 2 nanometer nodes required for next-gen AI chips. AI disruption risk, zero, they are enablers. So AI models require cutting-edge chips. Cutting-edge chips physically cannot be manufactured without ASML's EUV machines. It's a literal monopoly for the laws of physics. Of course, the worry is that China will put in money to catch up with that. But so far, they are clear monopoly. So let's look at both. So if you look at Nvidia, 87% for the next 5 years, we will not talk about 85%. Let's do the low end, 20% growth. P ratio 30 times. So at this rate, it is fair value at 11%, 30 times PE, from a historical of 66 to 30 times, 20% growth is factoring in this. If you think that the next 5 years is not going to happen that way, then the stock price will not rise beyond this. Buying at this level produces 11% return per year, 20% growth and 30. So these are huge adjustment downwards from 87%. But if you think that what the forecast will come through, 25%, and heck, it should be trading at 38 times PE, then you get a 21% return for the next 5 years. That the AI build-up will continue to last for a long time. There's a shortage of chips. Looking at ASML, it's a bit pricey. So we have sold away some of the ASML, taken some profit from it, simply to it's a bit too frothy. Yeah. So 15 times, 15% at 28 times PE, it's about 20% overvalued. But if you put 20% growth and 30 times PE, it is about fair value. So this company, of course, is cyclical. These are net beneficiary picks and shovels, bullet makers for the army to use. It's about this level that is sustainable. Okay, it's clear you don't think that we're going to be disrupted. And in terms of valuation, the chart, this kind of chart is, well, I would continue to hold. I think that ASML is a little bit more expensive. Look at Nvidia. ASML charts will be a lot more stretched. I think at this point in time, look at the amount of stretchiness it has had. So ASML is a little bit more expensive than Nvidia at this stage. It's still a monopoly, unlikely to be disrupted. Actually, the demand from AI will actually accelerate the business, the demand. So I would say that, yeah, ASML will be one that will take some profit from, but by and large, they are here to stay. Okay, quickly going through some of the top companies. Next, we have Microsoft. Revenue drivers, intelligent cloud, okay, is the main part of it. It's about 30-40%. Microsoft Intelligent Cloud, right, is about 35%. Productivity Office is about 35%. Personal computing is 30%, but it's declining. So we are looking at historical growth rates of about mid 30% for both. Mid to low future growth, mid to low teens. It's a AI disruption. Actually, it's an AI leader. So net beneficiary, through their OpenAI partnership, they successfully integrated AI directly into the B2B system. They are actually giving the run for the money for Salesforce. So they are capturing massive cloud workloads via Azure, and then the bundling strategy is to, they actually bundle CRM to fight with Salesforce. So this bundling strategy works. Now, Amazon, revenue drivers, AWS, e-commerce, retail, advertising, subscription. Historical growth rate 10-15%. They are putting a lot of money into CAPEX. AWS growth is accelerating, but the retail is slower, maturing engine. The AI disruption risk is mixed. It does get affected the most among the hyperscalers like Microsoft and Amazon. I will put them as one of the bigger, very CAPEX hungry business. So AWS is highly insulated, benefiting massively from AI model training. However, the e-commerce search is highly vulnerable if consumers shift to agentic AI to do the shopping that bypass the Amazon's lucrative sponsored product ads. Alphabet, revenue drivers, Google search, advertising, YouTube ads, cloud. I would say that Google search, YouTube ads is about 80% of it. Google Cloud, 15%. So historical growth rate, 11%. Cloud is 35%. So future will be 8-12%. It will slow down as we discussed with Booking.com. Well, I run a simulation of Booking. That is another company that is likely to be disrupted. If users start asking ChatGPT or Perplexity for answers, instead of Googling them, Alphabet's core search monopoly, which is massive ad margins, is directly threatened. They have models, Gemini, to fight back, but AI search costs more to run and monetizes worse than traditional blue links. Among the hyperscalers, the strongest one will be Meta. The reason being that I will rank Meta as the highest because there is real ROI that generates out of AI CAPEX, whereas the rest depends on they are actually supporting other businesses. AWS, Google is hit by ads, and it's also very expensive. I would say that Meta would be one of the best beneficiary of it. The advertising family of apps from Facebook, Instagram, WhatsApp is 98% of the revenue. And historical growth is 15-20%. The future is 10-15%. So the AI disruption risk, net beneficiary, so that open source Llama to commoditize the AI layer, ensuring no one can charge them on the AI tax. Meanwhile, they use AI flawlessly on the back end to optimize ad targeting and increase user engagement on Instagram Reels. So they are getting a payoff from there. Okay, the next group, financial plumbing and data monopolies, right? These companies sell trust and network effects. As discussed earlier, right, AI disrupts code, but it struggles to disrupt regulatory standards and global networks. What it's saying is that you are not going to construct, no two guys in the dormitory or garage is going to produce a competitor to Mastercard by coding it, or MSCI or FICO. So Mastercard revenue drivers, payment network and value-added services. Payment networks is about 70%, value add is about 30%. The historical growth rate is about 12%. So the future, we're expecting single to low teens, 10 to 15%. AI disruption, AI for fraud, tools, low risk is a payment network moat. You use them because the Visa and Master guarantees the integrity. You cannot use the AI to do it and then take over the payment systems because you can't sue the LLM. Next, MSCI. Index licensing is 50% of it. Analytics, ESG, private assets is half. Historical growth, double, single to low double digits, percentage of, they charge percentage of AUM. Future growth, single to low teens. AI disruption, well, so far AI enhances analytics and is low risk because they got a branding name. Regulatory mode, again, if you're a fund manager, you want to beat the index, you need to subscribe MSCI World. Okay, there are a lot of indices that they provide. So index licensing, they will give you the components, how they change their methodology. You're not going to use AI to explain and say, I'm going to save some money, I'm going to use AI, and we beat this AI constructed index. Next, Fair Isaac FICO. Revenue drivers, 50% is FICO scores. Software analytics, 50%. The historical growth rate is about 13% for the credit scores, and software is about 8%. Platform is 31%. Well, AI disruption risk is rather low. The banks have been using FICO scores to approve mortgages, car loans, and it is not just a math algorithm. It's not just about accuracy. It's a regulatory stamp of approval. You cannot securitize $1 million mortgage bundle to Wall Street using a proprietary AI model from a dorm room. You need FICO score for liquidity and trust. At this time, not likely to be disrupted. Okay, so then the third group is infrastructure, which I'm the most bullish, and cybersecurity. Brookfield is going to be increasing in the weightage of my portfolio. They are asset capital allocators. Revenue drivers, they own Brookfield Asset Management and Oaktree. That's about 40% of revenue. They have wealth solutions, which is insurance as well. So they have an insurance float to invest, and they got fee income. And the last part is that they have operating business. So imagine it's three parts. It's not just KKR, Blackstone, where it's just pure BAM, BAM. They actually have fee income. They have realizable earnings, which is a performance fee when they liquidate an asset. They have an insurance float to invest, because a lot of the insurances, life insurance, endowment, they are pretty long dated. They have also got permanent capital, which I love most, operating business that they invest side by side with their BAM clients. So this is an interesting business. They are into AI, they are into data centers, power generation, real estate. So not disrupted by AI at all. Historical growth 15%, future growth 15%, but the management has said that the distributable earnings will be 20%. So this company is very hard to filter out using GAAP, GAAP. You have to use non-GAAP, because when they acquire buildings or that, there's a lot of depreciation, and then the net profit comes down a lot. But the key to measuring them is the DE, recurring distributable earnings, okay, fee-based income distributable earnings, and also the entire distributable earnings, which includes realizations of the assets. And it's likely to accelerate to 15 to 20%. And you talk about undestructible, this is exactly it. So Brookfield is one of the few companies with scale to fund the massive physical reality of AI boom. Finally, we have Fortinet. Hardware is 35% of the business. Service is 65%. Historical growth rate is about 12%. Lately, it's gone up to about 17%. Future growth, mid-teens. Okay. AI powers a lot of threats, and Fortinet uses AI for detection. It is likely to be a bad net beneficiary. You probably can't build a AI even with Claude and that to say that I'm going to terminate my Fortinet, okay? Because cybersecurity is there. If you get hacked, you can sue the company for not doing a good job. But you can use Claude. Claude will complement the Fortinet as well to run the business, to strengthen it. Don't forget, AI can be used for bad things as well as good. And it's a massive nuclear arms race there. So Fortinet cybersecurity budget will be increased. Now, among the list of the companies, the hardware companies, the semiconductors, the Nvidia, the ASML is likely to be there, but be wary of the cycle. There will come a time where it will slow down, okay? And these are all CAPEX, infrastructure building business. It's likely to happen, but not so soon, because the arms race for AI capability is really going ahead, and they need all the GPUs they can. It's the hyperscalers, the Alphabet, the Meta, the Amazon, the Microsoft, and among them, I will put Meta as first because the advertising is one of the strongest, followed by Microsoft. I would be, in fact, I've sold quite a bit of the Google, the Alphabet, and Amazon, because the chart is down, we will hold on to it for a while first. It will probably not, I will not be increasing to it. Mastercard weightage will definitely go up over time, and so will MSCI. MSCI, incidentally, the CEO is buying back his own shares, and MSCI buyback is also 4-5%. So this is a huge indication. The capital allocation management is telling you that share price is too cheap. FICO, also there's a lot of buyback yield, and it is going to be a net beneficiary of spending, the mortgage applications going up with interest rates come down. Brookfield is one of the companies that the weightage should increase gradually. In fact, the share price, the target share price about $60 to $80 is really way undervalued. A lot of market players do not understand it, and Brookfield did not come out in the forefront for the bad press for private credit as well. They've been conservative, been running around for 100 years. Okay, Fortinet cybersecurity, it does have its challenges because they have to put money into CAPEX against this AI war to enhance their capability. However, it's very unlikely to terminate your Fortinet, right? And then you're going to switch over. It's still going to be another cybersecurity play. The one that is most capable of fighting against the AI hacking, cybersecurity threats is going to win. But I think Fortinet is going to increase their price. They're going to pass on some of the price increase to their clients. It's unlike the other SaaS that they are fighting just to survive. If you don't put in CAPEX, then you're going to lose the business. So here lies my explanation of the business of where it's going to. You can see that I'm veering away. SaaS is still a part of it. Not everything is gone, but I'm veering away to things that are low CAPEX, AI proof, that do the picks and shovels and provide energy. And that is where I'll be veering towards it.